Hi, this is Shane with the Rational Trader. It is Monday something or other. Monday 3rd. And here's my result for oil today. We'll look at gold in a minute, 320. And this is actually fairly interesting to see how this played out. Here's the open. Actually, what happened overnight? Let's see. Because oil's climbed back up to 53.5 here. We're hitting 50 earlier. So this is pretty ugly here, and all through here. There's a decent move down here, if you can catch that on the way up. Let's see, but we don't start trading until the open. So that's here, and so we get long there, and get just a little bit, right? So I actually like this trade. So you can see the pullback, right? Though the market is, you could argue that it's going the other way just because of the pullback fall. But the reason I like it is that you're getting in before the test of the high that's been set. And so if the market survives that test, then you're already in a good position. You're already at scratch when we get there. As it happens, it can't get through. So the way the trade management is set up now, get 10 ticks, move to entry plus 5. Really hard for me to grasp that. That's just not the way I've traded. But here, that gives you plus 50. And then, which helps defray the cost of that trade, right? This trade seems really late to me. But it's, you're at the value area edge, and the prediction is it's going to continue. And then you kind of rotate around here a bit. This is the POC right here. Right, let me draw it here. Right, it's that blue dashed line. And it's interesting because you come up to it, right, and we won't take a trade that close to the POC, but then you roll over and it's just enough that you're far enough away from the POC, but you're at the edge now. And then we take that trade for 16 ticks, get taken out on the trail. Another case where I would see this and go, gosh, I really want to use a bigger trail. You would just barely survive that pullback by a tick or two, then it would roll over for you. And then what happens? We try to get long here. Okay, this is really frustrating because we get long right there and we get stopped out almost to the tick. A 10 tick stop will survive that. But what I found is that in just doing the analysis over 110 days, actually it's 120 days now, you can achieve essentially the same profitability with a 7-tick stop, taking no more than 2 losses. So why take the risk? Why lose 200 a day if you can lose 140 on a max loss day? If in the end it's going to be the same. So we'll see. Again, it's this is a data point. If I keep seeing that over and over and over again, then I might make a change. But when I run the simulation on the data, so just to be clear, there's a point in time like right here, and I build a model through that point in time. It happens to be mid-June, and then I run predictions on that model from mid-June to now. That's the 110, 120 days I'm talking about. And so when I do that, when I run that replay, when I run that simulation, it very clearly shows that you can use a 7-tick stop and get the same profitability as a 10-tick stop. So you end up risking less per day. As a retail trader, it's easier to see a smaller loss like that than a bigger one. We get short here. And again, the trade management, here's a case where if I use that bigger trail, all right, I'm going to get stopped for scratch. So earlier, I'm not going to get stopped for scratch. Where was it? Back here. Where did it go? Oh, here. Right here. But here, I would. I'd make nothing. So the trade management for oil right now is at 10, at plus 10, move to entry plus 5. And then at plus 15, move to entry plus 10. So we make 10 here instead of nothing, instead of scratching because of that trade management. Let's see here, and then here again. All right, so at 10, move to entry plus 5. So we make 5 there. What would have happened here? 1, 2, 3, 4, 5, 6, 7, 8. You're going to get stopped out if you don't move the stop. If you move it to entry plus 1, that's all you're going to make. So making a little bit because you're just getting in. It's either a little too early or a little too late, right? Depending on how you want to look at it, because this market's going to do this little jag on you. There's a trade there, but we don't get filled. Okay. This is the green. You can see it from the green arrow. That little green arrow. And the Superman here is too loud. So along here, don't completely understand why I got taken out of that trade. Because we moved the stop to entry plus 10 at plus 15. So I think what I think that little triangle's in the wrong spot. I think it probably happened a little bit later. And then, because like if I look at that point right there, that's not 15 ticks away, is it? 43 to, yeah, but this one is in here. So I think that's probably what happened. Again, so the tight trail keeps me out of that, the rest of that move. That's, you know, I see that and that just totally rubs me the wrong way. And then let's see, that's it, right? So we don't get a signal in here, which is too bad because there's a nice move there. But all those little pieces end up netting 320. How many trades was that? Actually, we'll review a number of trades at the end of the week. So in gold, I was down 130. Where did it go? There it is, minus 130. Okay, so for the day, I was up 190. Let's take a look at gold here. This is actually a little interesting here. So we start at the open here and try to get short right there. That's a nice looking trade, I think, just as a human, because it broke through there and then couldn't get anything going. In fact, it broke through, you know, closed down and then tried again and closed down. So that I like that trade. Unfortunately, it's a little too soon. So minus 7 ticks, and then we roll over here. Get a signal to short there. We get filled on that bar. And here, because we're not trailing as tightly as oil, we end up, you know, you get 21 ticks, but you only make a tick. Again, that data shows the simulation data for gold. It's the same thing. You know, I build a model with data through the mid-June, and then run a variety of simulations and replays using different trade parameters. And it shows that if you trail that tightly in gold, it's less favorable to you. So again, here's a data point. I'll watch that and then see if I keep seeing this over and over and over again. I might make a change, even though the longer term data shows you'd be better off. And then we try to get short there. That is, what do I think about that trade as a human? That looks pretty good because you failed to break through there. And you're far from the POC and you're far from the support. Yeah, I like that trade. But market's going to thrash here. So another 7 tick loss, and that's it, right? Because we took a 7 tick loss there, made 1 tick there, took a 7 tick loss there, and then let's make sure that's set to take 2 losses, basically. So we stopped. So let's see what else showed up. So it would have been a long there that you're going to get stopped out on as it pulls back down. Another long where you're going to get stopped. So actually, 11:15. Yeah, I have it trading through 11:40, but you can see there is just no activity here. This is 10:30 right there, and that's 1 o'clock. 1 o'clock is right there. So is really slow. That's something I didn't test actually, was 11:30 versus 10:30. I was originally going just all the way out to the normal like index stopping time, so 20 minutes before the index closed at 12:40. Well, then I just looked at it and went, there's just no activity, so it's silly to be taking trades at that time. But the actual oil, the gold, let's see now, the gold pit, when there was one, it closed, I want to say 10:30. And so even though there isn't a pit anymore, a lot of those hour rules are still followed. Like the U.S. cash session opens at 6:30, even though it's 24-hour trading. And it finishes at, well, I guess in the case of the indexes, it's different because it finishes at 1 o'clock, and then all the markets, actually, even the electronic exchanges close. But you can very clearly see, I might consider stopping trading sooner here in gold. I'll have to do that. I'll have to do that analysis, and I've got the tools now to do it. So that's kind of what's happened here. As we've switched away from the two volatile indexes, I went and just took the time to build the simulation programs I needed. So for those of you that are sort of late to the party here, when we added the volume profile capability into the system, the replay functionality in Sierra Chart is so slow now that you can't. It's not usable. So if I tried to do like 100-day replay in Sierra Chart, it would take a week and a half, 10 days, literally. It's that slow. So I had to go write a program in a real programming language to simulate the way that we're trading here in order to get good data on how to adjust your trade parameters, and then what codes are more effective in each market. Let's take a look at the euro. This is sim, so note that it's sim. But this is running the new model with the new analysis and new codes. So let's see what we got here. We're trading from the London Open, which should be midnight Pacific. And then we got short there. Took a 7-tick loss. And that's it. I like that we're looking here. You can very clearly see that we're in there. That's exactly the right spot. Unfortunately, I didn't get a code there that I'm trading. I'm not actually listing the numbers here, and the reason is that for some reason they take on the form of .00000, and the number is just really big, so I need to figure that out. I'd like to see what that code is. Same thing here. I really like the fact that you pull back to the value area edge and then look for a trade. That looks good to me. But that's it. There's no other signals. So I missed the nice move and actually got in just a little too early. This is a nice looking trade actually, because you're breaking that resistance, that support, right at the edge. So it might be just a hint too late. You'd like to get in on the bar just before then. Give yourself a little room. But nonetheless, I'm not at all dissatisfied with that trade. Okay, so that's it. So we'll see. We'll keep running this, and this is the Rev 71 model. Very clearly shows that it's a tradable market across 100 days, 120 days now. We're simulating for our testing, and it's not quite as profitable in the simulations, only because the tick value is less, right? So the tick value for gold and oil is $10 per tick, and it's 6.25 in the euro. So that's it for today. We'll see what the rest of the week brings. Still focusing on, so basically our plan here is to, I'm trading gold and oil live. We'll keep doing that. And if we can get comfortable with the euro, we'll turn that on live and then start working on the next market, whatever that happens to be, whether it's the the pound or the yen or bonds. And then I think we'll probably check in with the indexes now and again and see if they've settled down. They still look super crazy, right? It's whipping around as these news comes in from all the different tariff / on again, off again trade wars. All right, so that's it for today. I will see you tomorrow.